So I'm going to be talking about game changers. First off, I've told you about the realization by asset owners. What that's resulted in is a world where people are now quite happy to go and invest cross-border. We've seen huge flows. We've got people in this room that are investing across in countries that they never thought they'd be investing in before. I saw one of the listed funds recently bought some stuff in Serbia and Montenegro. We've got guys moving into Croatia, Hungary, obviously Africa. I mean, that Kenyan REIT story is a fantastic story. I know it's taken years to build, but it's a fantastic story to see coming to life. So cross-border flows are moving. People are now selecting property based on the city that it is in. There's enough information out there now to be able to decide that you're going to invest in London offices and Hungarian retail. And guys are doing it. Those boundaries, that home bias that used to exist, is slowly being whittled away. In the South African context, we have to recognize that there is a very high correlation. And my starting chart for all of my talks is the cycles of property and economic growth in South Africa. We have to recognize that our property returns are going to be impacted by slower economic growth. And until we get the growth required, we are going to be fighting our asses off on the fundamentals to keep them growing. Don't kid yourself. We often look at the offices sector and say, right, fine, they're lagging behind. But we're all going to be fighting to keep the fundamentals growing at a rate that our investors want us to. We're in an environment of low to no growth. A lot of us are in sort of denial around that. That is the reality. Within that environment, we are now playing in a world of increased competition. I know we know it, we see it, but have we realized how we need to adapt and change within that environment? Have you thought about what it is that we do every single day when we come into work and say, well, maybe I should not be doing this anymore, or maybe I should be doing this slightly differently? But here's a couple of numbers instead of charts that I found interesting in reading over the last couple of days. 9 years. That was the last time the Fed raised interest rates in the US, other than December. The markets have recently reacted to perceptions that China's growth is slowing down, and they've reacted badly. When you look at that number, 40%, China's contribution to global growth, you understand why they may be a little bit nervous. I'm not going to give them all. You guys can join the dots when you see them and when you read through the presentation later. Firstly, inflation last year was around 5%. In 2016 and 2017, it's expected to be 7%. More importantly for me, is food inflation is expected to be around 11%. Okay. Another number that I found interesting, in a market where our currency has weakened substantially, you would think that our exporters or our manufacturers would be dancing in the aisles. Honestly. They've now got a situation over the case of about a month or two where people can't import the things that they make because it's too expensive, and they can export it because it's really cheap. But what's happened? We find that the monopolies within our manufacturing sectors or within our industries, 90% of all exports come from 5% of our exporting companies. What's happened to those small guys, and what can they do to change the game? Another number I think is very important. If we were growing, in 2014 we spent 257 billion rand on buying oil. Now, there may be a bit of an anomaly in there. I believe that some guys were finding somewhere to hide their oil, so they filled up the Saldanha spaces. So that may be in there. But either way, last year, we only spent 147 billion rand on oil. That's like taking a global tax out of the room. 110 billion rand of extra spend could have gone into something else last year, given the reduction in the oil price. In terms of credit, I think what's important here, 1.5 trillion rand of debt was extended to households in South Africa, but fortunately, positively, only 4.5% of that. That's only growing at 4.5%. The corporate sector is growing their debt at 16%. All right, some property numbers. Good news. 25% of all investment allocations in pension funds around the world was allocated to alternative assets. And yes, as game changers, all of you involved in the property sector are considered to be slightly alternative. 35% of that alternative amount is real estate. It's the biggest component. Around the world, the big pension funds are buying direct or private real estate. Allocations are increasing within that space. I think it might be slightly different in South Africa, but around the world where we deal with all the biggest pension funds and asset owners, they like direct or private real estate. The South African market we estimate to be around 5.5 trillion rand in size, capital value, 1.3 trillion rand in SA commercial property. If you're looking for opportunity, I'm not sure what your numbers say, but that's 1.3 trillion rand of it right there. We're looking at an 8% return for SAPI last year on the listed sector. And we estimated, well, our numbers in June at 2014 showed that direct property returned 6.5%. So you can almost double that slightly to get to a return for next year. We'll be releasing our index at the end of March. What's interesting for me is that the valuers' assumptions in terms of their perpetual growth on rental, now this is the number that you should know, because this is the basis of all property in my world, is 5.6%. So we're talking inflation at 7%, and we're looking at actual rentals growing on average at around 5.5% to 6%. That's what the valuers are assuming. More importantly, and it's a big discussion in the property world amongst the guys that are sitting there, is that we've got discount rates at 14.5%. Now, 14.5%, if that's all property, obviously it changes by sector. But what that means, and what may well change the game in property, is that our valuers start saying that that is too high. Maybe that is just too conservative. Maybe we need to be a little bit more like the listed sector on the underlying fundamental valuations and take some of the steam out of that discount. What we're looking at here is a forecast that is now saying we're expecting to grow at about 0.8% this year and probably 1.1% next year. Not exactly shooting the lights out. You don't have to have enormous growth to be a game changer. Anybody can grow in a rising tide. What you need to be is somebody that grows in a tough market. Then you need to be a game changer. So the game changers. 1, asset selection will drive out performance. The guys that work this out, that work out which assets to pick and the active decisions that go with assets, buying and selling, those are the guys that are going to change it. Winners will be those who fight smarter and have the stamina to stay the long haul. By stamina, I'm sort of referring to deep pockets. It's going to be tough. Don't joke. I've got some retail owners that are playing this game on their own balance sheet. I mean, that's got to be tough. You know, you try and offer a rental concession when it's your bank balance that pays it. It hurts. You know, when you turn to the big mothership that's got this huge bank balance, it's a lot easier. It's not fun, but it's easier. Future-proofing is a game changer on the global game. If you are not using green and you don't believe in the sustainability story, you are behind the curve. We've got numbers that show it, but I have no doubt in my mind that that is a game changer. And diversification is essential. We're seeing it in the market. We're seeing it everywhere else around the world. The fact is that you need to work out of this market that's very contained, very coagulated, and start looking at potentially other sectors. And the guys that do it, that healthcare sector is waiting. We've got corporates waiting to unload their assets and create funds for us. And then you've got obviously the residential and or cross-border investments that can take the game forward. So we're going to see a shift in behavior. I might not get to offices and industrial, but I hope you forgive me. We're operating here now because of that highly competitive space, because of what's happening in the economic growth environment. We are seeing consumers change behavior. At the top, we're looking here at the foot counts, the number of visits per square meter, and we're looking at the spend per head. And at the top there, back in the heyday, when we all used to go to the Woolies down the road, and then we'd go to Gateway, and then we'd go to, you know, we'd spend money whenever we wanted, visit as often as we want. That was the heyday. You can see it quite clearly on that chart. What's happened now, in 2015, is we're not visiting shopping centres as often. Think of your own behavior. Have you switched to convenience and one-stop shop? And what we're seeing is, although you're going there less often, you're spending a lot more. In the retail mall space, if you want to be attracting, you have fewer chances to grab that wallet share. What are you doing to make sure that you're relevant in the space? The biggest game changer I think that's going to happen, other than the one I'm going to mention last, in the retail space specifically, is when someone cottons on to the potential-based rentals. At the moment, we charge our rentals based on trading densities, potentially trading density growth, and rental per square meter of categories or similar categories. When someone cottons on that I can get a high street model going like I would in Cannes, where someone that has access to the busiest corridor in my shopping centre pays more for that potential than someone in the cold spot by the postnet at the back office. When someone works out how to do that, that's going to change the way we see shopping centres and the way we manage costs inside shopping centres. We have to change that approach to some game changers going to come in and change the line shop ratio approach, particularly the way the costs are spread between the nationals and the line shops. I don't know how to do it. I'm very interested to see when it happens, but that's going to be a game changer. And then obviously green. Final one, the internationals have come in, they've already changed the game to an extent. But I think the biggest change, the biggest game changer is going to be when some retailer steps forward and says, I can no longer be in that mall, I have to be in that mall. When that happens, the world will change for shopping centers. It'll change for retailers, because that guy's going to have cojones that are like the size of a truck. At the moment, everybody says, well, I have to be there because if I'm not there, I'm going to lose market share. But at some stage, the cost of that investment is going to outstrip the benefit that they get. And I'm really interested to see when that takes place.